What's up, it's Ron. You ever stare at a crypto chart and wonder what do these lines actually mean and how do people trade off of them? Well, in this series, I'm breaking down 5 of the best crypto indicators for beginners, starting with one that changed my trading game, and that's moving averages. Each series will cover one of the indicators, how I use it in trading and why it's so important, and I'll even explain it in great detail. Using indicators in day trading or swing trading is super important because it'll help you make smarter, more informed decisions instead of just guessing. They show me things like momentum, trends, support and resistance levels. Basically, they help me understand what the market is doing and where it might go next. Indicators don't guarantee profits, nothing does, but they give you an edge. And in trading, having an edge is everything. Without them, you're just guessing. With them, I'm making calculated moves. And quick disclaimer, this isn't financial advice, so always do your own research. And hey, if you appreciate insights like this, please hit the like button. It really helps push this video in front of beginners trying to learn how to trade crypto and helps your boy out and is super appreciated. You'll definitely want to stick around to the end when we look at the moving averages on the charts and see how they respond. Moving averages completely changed my trading game, and once I learned how to read them, everything clicked. They help me filter out the noise and really focus on what really matters: trend, momentum, and clean entries. So what are moving averages and how do I use them? A moving average is simply an average price of a coin over a certain number of candles or time periods. It's a line that illustrates a smoothed out price action so that you can clearly see the overall trend, whether the market is moving up, down, or sideways. And the main reason that it works is because a lot of traders are watching these exact levels. So they work because of how many eyes are on them. The price tends to bounce or reject off these moving averages because it's kind of like a self-fulfilling prophecy. Everyone's reacting to the same signals. Real quick, whenever I talk about indicators in trading, please keep in mind that time frame matters. So on a chart, I personally use these: the 15-minute, the 1 hour, the 4 hour, and the daily charts, depending on how fast I'm trading. Now, if you're scalping, stick to lower time frames, and if you're swing trading, the 4 hour or the daily chart will be better. But the principles are the same across the board. So moving averages on higher time frames like the 4 hour and the daily are a lot stronger and more reliable than those on lower time frames. Why? Well, because they reflect way more data in market participation. For example, say you have a 200 moving average on a daily chart. That is pulling from 200 full days of price action, which gives you a much clearer picture of the overall trend. And don't worry, I'll explain this in full detail throughout the video. On the flip side, a 200 moving average on a 1-minute chart is just using the last couple of hours of movement or the last 200 minutes. And those small moves can get super noisy and manipulated, especially in crypto. Price can whip around above and below moving averages on lower time frames all day long and not mean anything. So when I see price break above or below a major moving average on the 4 hour or the daily, that gets my attention way more. And that's what the big dogs, institutions, whales, and serious swing traders are watching. So here's how I think of it: lower time frames, speed, precision, but more noise. Higher time frames, slower, but way more reliable. That's why I always try to zoom out and check the moving averages on higher time frames before entering my trade. If everything lines up across multiple time frames, that's where the real confidence comes in. Instead of reacting emotionally to every spike or dip, moving averages help me stay focused on the bigger picture. Okay, now there are simple and exponential moving averages. The only difference is the weight that it puts on the most recent price action. So for example, a moving average on a SMA, or a simple moving average, is spread across the entire period. And for the exponential moving average, or EMA, is what you're going to hear in this video, it puts more weight on the recent price actions and therefore is reacting faster than the simple moving average. It's up to you on which one you prefer. In this video, we will be using the EMA. We will use the 9, the 20, the 50, and the 200. Each of these will serve a different purpose in my trading strategy. So let's go ahead and jump into the chart. Let's go ahead and start with the 9 EMA first. The 9 EMA reacts very quickly to price changes, so it helps to see the momentum in real time. If the price is above the 9 EMA and holding, it's often a sign of a strong short-term bullish momentum. Now, if it's below, it can show weakness and shift to the downside. So right here, I have the ETH USDT chart. What we want to do is go ahead and activate the 9 EMA. EMA. Right now we're on the daily chart. So what we want to do is go ahead and zoom in so you guys can get a better look at what's happening here. For example, right here, let's go ahead and give my marker. You see it broke. It was bearish for a moment. It came up and then it retested the 9 EMA. Same here. It broke, came up, started riding along. The 9 EMA is a resistance level. So you can kind of see that happening there. And so this is on the daily. Let's look at the 15. All right, right here you see it kind of went over. Let's go ahead and draw that in. Under. It's kind of riding along, but then it drops bearish for a moment. Then it comes and it taps and rides along this 9 EMA. Remember, this is the fast, but a little more noise, right? This is what we spoke about earlier. So this is the 9 EMA. Let's go ahead and look at the 20. All right, so you notice with the 20, there's a little bit less noise than you saw with the 9. The 20 EMA, or the 20 moving average, sits right between the fast reacting 9 and the more stable 50, which we'll look at here in just a moment. It's kind of like the middle ground, and it's super helpful for both trend confirmation and pullback entries. When I'm trading, I use a 20 EMA to spot the healthy pullbacks in the uptrend. If the price pulls back to the 20 EMA and bounces, then it's often a great entry point for a continuation move. It's also helpful for spotting consolidation. If the price starts riding along that 20 moving average sideways, then it usually tells me that the market is taking a breather before its next move. So you could kind of see this very clearly happening. You'll notice how it's bouncing off the 20 EMA. Then when it breaks through, it goes lower and it starts to kind of retest. It broke through, came back, started riding the 20, comes here, rides a little bit, falls under, pulls back towards the 20. And so you'll notice that you can see a little bit better of a picture when you're dealing with the 20. It's going to remove the drawings. Let's look at the daily. All right, so this gives us an even better picture. It looks like it broke under this 20, comes back up, rides along it, then dips under, pulls back to the 20 EMA. And you see that it continues to kind of do that. And the 20 EMA is kind of looking like resistance. Over here, it's support. All right, so what we want to do now is it's going to remove the drawings. And I'm just going to layer this 9 EMA on top so you can kind of see. Something to look at is if you are day trading and you see the lower time frame cross the 20 or the larger time frame, that it turns bearish. If you see it cross back, it turns bullish. Cross back, bearish. Another good strategy when using these moving averages. Let's go ahead and close these out. Let's jump into the next one, which is the 50 EMA. Now the 50 EMA is a midterm trend indicator. It doesn't react as fast as the 9, but it gives me a sense of whether we're in a strong upward or downward trend. If the price stays above the 50, that usually means buyers are in control. When it breaks down, it might be a warning of a deeper pullback or reversal. This is my go-to for confirming if a trend has real strength behind it. I use the 50 and the 200 EMA a lot. So let's go and turn that one on. Now let's see what we can spot here. Let's grab our marker. We see this incredible bullish upward move way above the 50, comes back, kind of rides along it, comes back up, breaks under. Now it becomes resistance. It's having trouble breaking the resistance, and then boom, it becomes bearish. Let's go ahead and go to the 15-minute. Rides along, goes bearish, breaks through, becomes support, and then you'll see that. Let's go to the 4-hour chart. All right, comes here, tests the resistance, becomes support, breaks through, then becomes resistance. That is the 50 EMA, watched by a lot of traders. Let's go ahead and cut that off. Let's look at the next one, probably the most important one. This one's a big deal, the 200 EMA, which is watched by tons of traders and acts like a line in the sand. When the price is above the 200, we're generally in a long upward trend. When it's below, we're likely in a major downtrend. Let's go ahead and turn this on. Just like we said, when it's above it, upward trend. When it breaks below it, comes downward trend. Huge moving average to make sure that you guys are utilizing. Typically, you'll notice when something breaks the 50 EMA, it kind of tends to want to gravitate towards the 200 EMA. And so it's just great when you use them together. Let's go ahead and add the 50 EMA now. We'll see that when it breaks through the support of that 50 EMA, you see that it tries to touch the 200 and then it rejected here and then it became bearish. One thing I really respect about the 200 EMA a lot is that it's just not a number. It's a major support and resistance that institutions and big traders pay attention to. I trust the 200 EMA because the whales do too. When you use all of these things together, it tells a story. The 9 tells me what's happening right now. The 50 shows me the short to mid-term trend, and the 200 gives me the bigger picture. Using these moving averages is only one tool in the arsenal of indicators, but it is the first one that I would recommend mastering. It can help you avoid fake outs and know when to enter and exit. They don't predict the future, but they make reading the market a lot easier. So let's go ahead, and we kind of touched on this, but let's talk about when the EMA intersects another EMA. You may have heard of the golden cross or the bullish cross. Now, this is when a smaller EMA like the 9 or the 20 crosses above a larger EMA like the 50 or the 200. This signals that buyers are gaining control and the momentum is shifting bullish. Now, if this happens on a strong uptrend, I look for long entries, especially to retest some of the EMAs. So for example, if the 9 EMA crosses above the 20 or the 50, short-term momentum is turning bullish. If the 50 EMA crosses above the 200, which is the golden cross, the 50 crossing over the 200, that's strong confirmation for a long-term uptrend. Right here, if we look at the 50 and the 200 like we did a moment ago, it crossed. And so what happened after that? It turned extremely bullish. It's very important to look for this golden cross. When you see this 50 cross the 200 above, you notice this happening. You might notice it, right? We can't predict the market, but when you see it crossing under, it becomes bearish. We'll talk about that here now. All right, now for the bearish movement, EMAs like the 9 or the 20, when they cross below the larger ones like the 50 or the 200, sellers are taking control and the momentum is shifting bearish. If this happens on a downtrend, like we're seeing right here, I look for short positions or short opportunities, and I really exit from my long positions if I have any open. When the 9 EMA crosses below the 20 or the 50, short-term momentum is turning bearish. When that 50 crosses below that 200 moving average, then we see strong confirmation of a downtrend. And again, you can see that here in this Ethereum chart. It's a long, look at that downtrend right there. So that's an incredible short entry. If you were to trade this and you waited, you saw this cross, it did this, you wait for confirmation, it retested that 50, you went ahead and entered your short position here, did a stop loss above that 200, you could have made a lot of money on this type of trade. This is also known as the death cross. Not all of these crosses mean a guaranteed trend shift. Sometimes you have price fake outs with these crosses and then it just reverses back. But this is why you got to make sure you add a stop loss. This is why I combine the EMA crosses with other confirmations like volume, support and resistance levels on top of the other 4 indicators that we'll talk about in this series. So make sure to subscribe to follow the 5-part series. Mistakes happen, and when I first started using moving averages, I jump in just because the price crossed one of the EMAs. Big mistake. Crosses happen all the time, and not all of them mean anything. I learned to be patient and wait for confirmation and look at the bigger picture. It's about learning from these mistakes and getting better as a trader. If you're new, I recommend going back to the charts and practicing spotting the EMA bounces and crosses. Just scroll back in time and see how price reacted around these EMAs. That's how I built confidence before taking real risk. Moving averages is just the first indicator in the series. Next up in part 2, I'm breaking down one of the most underrated, powerful indicators for catching breakouts early. So if you are serious about leveling up, make sure you hit that sub button, turn on those noties, and I'll see you in the next one.